Okay, Jeffrey, we're going to get going then. Hi, everyone, and welcome to this IRF group call with Jeffrey Christian, President and Founder of CPM Group. I know some of you have been on our calls previously, but for those that haven't, independent research forum IRF is a company that I set up 5.5 years ago to ensure that investors had access to an unrivaled group of high-quality independent researchers and specialist data providers. Across our now network of over 290 providers, from macro to stock-specific research, we can meet the needs of any investor requirements. We put on calls such as this to promote our providers and allow investors to hear the latest views from seasoned market practitioners, which brings me nicely onto our guest speaker, and we're delighted to have Jeffrey from New York with us today. He has been analysing metals since the 1970s and founded CPM Group in 1986, spinning off the commodities research arm from Goldman Sachs & Co. and its commodity trading division, J. Aron & Company. CPM, with a number of senior analysts, produce research reports on supply, demand, market and price information, as well as projections under varying market conditions. Their research very much blends the top down with bottom up, which is why they have been so successful at predicting major market moves. Jeffrey will be delivering an approximately 30-minute presentation on why he believes the bull market for gold and silver is far from over, after which we'll move to Q&A. Do feel free to post any questions in the chat box during the presentation when I'll read them out during the quick Q&A, or wait until the session starts. It's worth noting that Jeffrey and CPM's expertise certainly doesn't only cover precious metals. They also extensively cover base metals, specialty metals, including EVs, in which Jeffrey wrote a book as early as 1979, pioneering stuff. And finally, they cover energy and agriculture. He'd be very happy to field questions on any of the commodities which they look at during the Q&A. So without further ado, over to you, Jeffrey.
Thank you. Thank you, Edward. Thank you, IRF. And thank you, everybody who's joining. I have about 50 that I have pulled together to talk about the bull market in gold and silver and our thesis, which is that the bull market is not over. So that means that if I'm going to limit myself to 30 minutes, so we have plenty of time for Q&A, I have to go about 30 seconds per slide. So sit tight, and I hope not to talk too fast when I go about it. So our thesis today is that the bull market for gold and silver is not over, that what we're doing is we're in a consolidation phase on a long-term view. And I'll get to that a little bit more. First, a little bit about CPM Group. We have been using the research to describe what we do. We do research and we do consulting. And the consulting includes financial engineering for asset management and for commodities management for investors and for consumers. As Edward said, we marry a macroeconomic top-down view I'm just going to do something here. We marry a top-down view of macroeconomic and political environment as it affects overall commodities and overall economic activity. And we marry that with a microeconomic bottom-up view of each market. So we will look at mine production, secondary recovery, mine production by mine, by deposit, by company, by country, secondary recovery from end-of-life materials that come back into the market, fabrication demand, investment demand. And most of this is not really publicly available information across commodity markets. People in precious metals tend to think that they're kind of secretive, but the reality is that there's not good data on fabrication demand and investment demand and secondary recovery across commodities. And energy, oil, which is the biggest commodity market and the most important economically, most countries don't measure how much petroleum is consumed in their country. They measure the amount of petroleum coming in, either as distillates, gasoline, petrol, diesel, jet fuel, or crude petroleum, and the amount in inventories, and they guess how much is being used by the difference between those two and changes in those two. Our third pillar is what we call market conditions. And these are things that are too short term to show up in supply demand fundamentals, but they have a major effect on prices, at least on the short term, if not on the longer term. And then we use technical analysis. Once we have a view of where our market is going in terms of prices, higher or lower, we will use technical analysis as well as our fundamental analysis to post how high or how low we think a market can go and the timing and pace at which it gets there. So that's what we do. And we have a pretty good track record. A couple points up front to my thesis. Our issued a buy recommendation in November of 2000 for gold. Between 1980, when I took over the J. Aaron Research Department, and then CPM on out of Goldman Sachs in 1986, until 2000, we were telling people on an intermediate term perspective, don't buy gold, sell it. If you're going to do anything with gold, go short right now. 68% of the time in that 20-year period. In November of 2000, we said buy gold because the economic and political and financial market environment going forward for the next several decades will be much more virulent than it was in 1979, 1980. Now, in 1979, 1980, you saw gold go from about $200 an ounce, less than $200 an ounce, to $850 an ounce on an intraday basis. You had 14% inflation, 21% interest rates. Soviet troops had invaded Afghanistan. Oil prices had quadrupled. We had American hostages in Iran. It was a very nasty time. And it ended 1982, 1983. 2000, that we thought that economic and political environment would be much more 70s for decades to come. And in that kind of environment, we would see an upward shift in the investment demand curve for gold and silver as safe havens and portfolio diversifiers. And that would take precious metals prices, gold, far past the $850 that we had seen on an intraday basis in 1980, when the average annual price was about $612. We have seen that so far. Now, we went further and we said, we thought that you'd see legs. And what our view is that from 2001 to 2011, you saw the first leg when prices went from $270 an ounce to $2,000 an ounce, or $1,900 an ounce. 5-year consolidation period. We saw the price go back up and touch new record prices in August of 2000. It's come back off slightly since then. Our view is that this is a consolidation and the beginning of the next leg up, which should take gold prices to record prices. Our view is perhaps $2,400, $2,600 at some point over the next 3 to 5 years. We're not of the school that says it's going to 3,000 or 5,000 and staying there. That's not how commodity markets work. That's not how financial markets work. That's not how the gold market works. When the price goes up, it comes back down. It, generally speaking, doesn't come down back to where it was prior to the spike up, but the spike up brings in supply from mines and from scrap. It reduces fabrication demand, and you have investors who take profit. So you see the price come back off. Our expectation is that the price goes up, makes new record prices within a reasonable level, around $2,500, and then comes back off toward the end of the current decade. So that's our thesis as to why the bull market's there. In terms of silver, we also are, we've seen a similar pattern in prices. Our expectation is that the silver price could well exceed annual average prices that we saw in the past two markets. It got up to $50 on an intraday basis in 1980, but the annual average price was about $21. It got up to $50 in 2011, but the annual average price was about $36. Our expectation is that the annual average price will be in excess of $44 in the next spike up at some point over the next few years. It all comes down to investment demand. So miners mine. Secondary supply is somewhat price elastic in that you can see changes in the jewelry sector, less so in the industrial sector. Fabrication demand is relatively less dynamic. All of those things have an effect on the price. But what really sets the price is investment demand levels. And that's because A, there's a lot more investment money than there is gold in terms of dollar value of gold that's out there. And investors are fully free to come and go. So you'll see periods of time, the black bars here, where investors are buying 20, 30, 40 million ounces of gold, physical gold, in a given year, and they tend to drive the price higher. You see other periods of time when the economic environment is less hostile and they're buying less than 20 million ounces a year, sometimes 7 million ounces. 3 times since 1968, they were net sellers of gold. When investors are bearish on gold, they don't sell it, they buy less gold. And in those kinds of periods when things are not hostile economically, you see investors buy less gold and the price tends to fall. So we pay a lot of attention on what drives that investment demand. What are the things that matter? Investors buy gold for 6 reasons: safe haven, a portfolio diversifier, an alternative asset, an inflation hedge, a currency hedge, as a form of savings in many countries and really around the world, and as a commodity. So we look at all of these macroeconomic factors as well as the fundamentals. One of my critics in 1989 said CPM Group is not really good at calling the gold price. It's just very good at calling global economic trends and the stock market, because we pay a lot of attention to what's going on with those. Inflation, I'll make the point, has not been important to gold and silver for 20, 30 years now, and it's probably not going to be important. We're not inflation hawks. We're not fearful of inflation. On a long-term basis, we're much more worried about deflation. That's been interrupted by the pandemic and the economic lockdown, but that's a shorter term or intermediate term scenario. Here's some numbers about that. We are worried about interest rates, the dollar and other currencies, the international currency regime, and what's going to happen to it over the next several decades. The stock market and bond markets are particularly important at this point in time in terms of investor attitudes toward gold and silver. They've been doing very well for a number of years, and investors who are heavily invested in stocks and bonds are extremely concerned. The higher the stock market rises, the greater the anxiety about what's going to happen when it comes down. Overall financial market stability or instability, overall economic growth, fiscal policies, especially deficit spending and debt, and monetary policies, the political and gold's fundamentals. All of these things matter. So we look at all of them, and we spend a lot of time looking at these things and going. Taking those 6 factors, you can say green, red, or yellow. And you can see the first one, inflation hedge. 1979, when inflation was 14%, it was flashing green and investors were buying gold as an inflation hedge. The same was true 2009, 2011. But for most of the period of time since 1983, inflation has not been a problem, and gold hasn't been necessarily an inflation hedge in the minds of investors. So people will tell you that gold is dead as an inflation hedge, and it's like, no, gold's not dead as an inflation hedge. Inflation has not been a problem. And the current question is it a problem now? Our answer is not as big as a lot of people think. And our view is that investors see it that way too, because they're not racing into gold and silver because they're worried about inflation. They're worried about everything else. Safe haven, it's flashing yellow right now. It's not a problem, but it's not exactly sanguine. Currency hedge, savings, alternative asset, portfolio diversifier, those are the factors that are driving investors to buy about 30 million ounces of gold this year. So it's going to be strong. I think it's closer to 20 million ounces. I stand corrected. And as a commodity, it's neither here nor there. So you put all that together and you say, well, what's your economic outlook? We've seen a very steep recession last year with the economic lockdown. We're seeing a recovery globally right now, and we're seeing expansion in that we're past the the fourth quarter of 2019 in China and the United States. Our concern is that 2024, 2025, we see another recession on a global basis, and we see increased financial market instability, and we see much more hostile political issues, both on a global basis and within individual countries, including the United States, China, and other parts of the world. We do think that Brexit may be contagious across Europe, and you're going to have to see, or you're probably going to see a very serious rethink of the European Union and the European Union's constitution going forward. And we think all of that comes together 2024, 2025, and it creates an environment where investors say, I think I should have more gold and silver in my portfolio. Small increase in US Treasury interest rates this year, and it has had an effect of driving down the stock market and as well as gold and silver. But if you look at it, it's been relatively small. Interest rates are still at historically low levels on a nominal basis on the left-hand side and on a real basis. And on a real basis, interest rates have been negative for a very long time now, and they're probably going to continue to be. And that's actually what the Fed has told people. We look at, we think that, yes, they could get up to 2% next year. They might get up to 2.5% in the long run, which is basically what the dot plot that the Fed puts out, the FOMC. So we're basically saying, yeah, we think the Fed's actually got it straight. If the relationship between interest rates, real interest rates, and real gold prices, it takes a much higher level of interest rates than is projected to be seen in the long term before effect on gold. The key interplay between interest rates and gold is that when interest rates are low and real interest rates are negative, the cost of buying gold diminishes. And the returns that you can get there diminish, so that you start looking for alternative assets that might appreciate in value, like gold. If you look at the scatter plot on the left here, you see the relationship between changes in interest rates and changes in gold prices on a real inflation adjusted basis is something like -16. There are periods of time when they're moving in opposite directions. There are periods of time when they're moving in the same direction. And on the right-hand side, you can see when you have negative real interest rates, it really takes a real interest rate of +3% or more before you start seeing a negative effect on investor interest in gold. So if you're talking about 2% inflation, you're talking about 5% nominal rates. If you're talking about 4% inflation, you're talking about 7% nominal rates. We haven't seen those since the early 1990s, and they're not on the horizon for the next decade, according to the Fed and most other mainstream investors. So we don't see interest rates as necessarily being something that's going to be a particularly strong headwind toward higher gold prices, at least beyond the next few months. Advertisement that I got back in late July. The dollar is already in free fall. This is the way people market gold, based on fear. The dollar is going to collapse, interest rates are going to skyrocket, the world's going to collapse, the treasury is going to collapse. The interesting thing is, okay, it came out in late July and they actually had August numbers here, but there's no scale here, right? The dollar is already in free fall. The dollar's in free fall in that it's been in this trading range from 2015 until now, and it's moved from a little bit above that trading range to the bottom part of that trading range. The dollar is not collapsing. And in fact, that trading range is significantly higher than the trading range we saw from 2004 to 2015. There is a long-term downward trend in the dollar, which makes sense because the dollar has moved from back here where it was the basic reserve currency, it was the de jure reserve currency, to now when it's a de facto reserve currency, and the US government is working very hard to make people want to have something other than the US dollar. But the reality is that the dollar is not collapsing. And if you look at it on a shorter term basis from the early 2000s, you can see the same thing. So we're not necessarily concerned about the dollar collapsing, but there's a great uncertainty about where currency regimes are going. And there is a distaste for having 62% of monetary reserves and about 75% of private sector wealth in US dollars. So there is an effort to diversify your assets away from the dollar, both on the part of central banks and the part of the private corporations and investors, but it's probably not going to cause the dollar to collapse. Inflation, as I said, it's concerning, but it's not worrisome. We did see this spike up over the last several months, but you have to understand this is year over year. And in 2020, the world was locked down and people weren't buying things and prices were relatively low. In 2021, we're coming out of the lockdown. People are buying things, supplies are disrupted, political issues are also causing supply disruptions, and you're seeing prices higher. This is year over year. At it on a month-to-month basis, you can see that inflation rose very sharply in March, April, May, June, and it's about half of what it was back then. And if you look at this 0.3, 0.4 in August and September, and you compare it to month-to-month changes in inflation, you can see that we're pretty much back where we've been since the middle of the 1990s and lower than we were back then. We had a couple spikes up during the lockdown and during the coming out of the lockdown, and now we're coming back to where we are. So we're not concerned about inflation so much because even while it's risen to these levels that were very low compared to what we saw in the 1970s when everybody was buying gold and silver because of inflation. So we're not big inflation hawks either. We're basically looking at a relatively sanguine economic environment for the next 5 quarters. But we're also looking at storms on the horizon. Now, the relationship between gold prices and inflation, we always tell people the good news is don't worry about gold prices because you're not worried about inflation, because inflation really hasn't been a major driver of investment demand in gold prices since the 1970s, since the early 1980s. 1983 really changed everything. And you saw inflation ratchet down and stay down and actually move to lower levels for a big period of the last 10, 12 years. And during that period of low inflation, you saw gold go from $270 to $2,000. The correlation over the whole period is 9%. Since 2008, it's actually negative 5%. So investors have been buying gold not as an inflation hedge, but as a currency hedge, as a portfolio diversifier, as an alternative asset. With low interest rates, people are looking. The stock market has done extremely well since the Great Recession. In fact, you look at this and you say, gee, that's like a managed market. It's not exactly a managed market, but the steady stream of money into banks and institutional investors, which has led to stock buybacks and a variety of stock things, have actually contributed to the resilience of the stock market. But as it gets higher, people's anxiety grows. The real economy, again, relatively sanguine. We had a big economic lockdown, unlike other recessions that we've had, because it was engineered by governments around the world. Recovery, and now we've come back down. And states were now into an expansion phase in that we have higher GDP in dollar terms than we had prior to the lockdown. Fiscal policy is one of the big spheres. Deficits, and they're persistent deficits. And this is the same thing, basic percentage of gross domestic product, federal deficits. And you can see it's almost as bad as it was in the late 1940s. But it's very problematic compared to what we've seen since 1947. Policy, the Fed has plenty of ammunition. The Fed is basically a banking system. And, whereas people were shocked, it went from $1 trillion of assets to $3 to $4 trillion of assets. Now it's at $8 trillion of assets. Its lending capacity is now on the order of $75–80 trillion. So when people tell you that the Fed is out of ammunition, they're wrong. The Fed has tremendous amounts of ammunition, but the Fed can only stanch the bleeding and keep us out of depressions. It cannot engineer long-term growth. It depends on fiscal policy, and the fiscal policy is clearly broken. And that's what makes us think that while we're looking relatively sanguine about the economy, interest rates, and the currencies for the next 5 quarters, on a longer term, I think everything comes home to roost. And our wet finger in the air tells us that, and our macroeconomic analysis tells us that it's probably going to be 24, 25 when we see the next recession and the next financial crisis. And when that prices rise. A few points on gold. Gold supply, you can see mine production has fallen for a few years. It's up a little bit this year, but it's not back to 2019 levels. Total supply has held up because you saw secondary recovery rise, partly because people are recycling more electronics and other gold-bearing assets, but also because people were selling jewelry in order to have cash during the recession. That the world's running out of gold and silver and copper and oil, and none of that's true. There's no, peak oil was a theme that people used to sell oil products a decade ago, and we were producing more oil now, and we have more oil reserves and resources on a global basis than we did 10 years ago. The same is true of we have about 30% more reserves, known reserves, than we did in the late 1980s. Fabrication demand is kind of weak. It's jewelry demand. It's very price sensitive. When the price of gold rises, jewelry demand will fall. When the price of gold is flat to lower, jewelry demand rises. And vice versa. Of gold rise, we've seen jewelry demand start to fall. Central banks buy more gold. Those central banks that bought a lot of gold in the 1950s and earlier under the because they used gold to settle international trade, were selling a lot of gold actually from the 1970s through the mid-aughties. They've basically sold the gold they want. They have about half of it in many countries. A lot of countries like Switzerland said, we want to sell half of our gold. We have 98% of our monetary reserves in gold. We need currencies to defend the Swiss franc if somebody decides to sell it. So we're going to sell half of our gold. We're going to keep half of our reserves in gold, but we're going to have a lot of dollars to support the Swiss franc if we need to. They've sold pretty much what they wanted to sell by 2005. All of those central banks in Europe, Australia, Canada, Japan. And since that time, you've seen other central banks, Kazakhstan, Russia, China, India, that were not particularly big trading partners prior to 1965, start to rebuild their reserves. About 8 million ounces last year, about 9 million, 10 million ounces this year. And one of the interesting things is this year you saw central banks buying at that 1780, 1800, 18. Very price sensitive compared to individual investors. And what they're saying is we think that current prices around $1,800 are actually good prices at which to buy from a long-term perspective. It is a very bullish message to the investors, and it's the investors who set the market. I have 3 slides about myths about the gold standard. Gold's purchasing power has never been constant. People talk about the golden constant, but it hasn't been there. Even during the gold standard with a fixed nominal gold price, you saw gold prices deteriorate as inflation took its toll. After we severed the ties between the gold and the dollar and the gold price was free to rise on a nominal basis, you saw this volatility. Also, the dollar's purchasing power was not stable under the gold standard. It was extremely volatile and it basically fell. This is 1970. And, oh, well, the dollar has lost 75% of its value since we went off the gold standard. Yeah, it had lost 85% of its value prior to that. So it's just not there. At the period of free gold prices since gold 1968, the range in real prices has been between, say, $60 and $800. So about 12-fold, plus or minus 12-fold, the purchasing power is stable. A few points on silver. We have seen investors back away from being long silver. The peak was back here in 2016, 2017. It came down, it got back up as people were buying silver. We've seen a decline on a gross basis and on a net basis. And we've also seen an increased willingness on the part of short-term investors to go short silver, which has price consequences. Silver trading volumes, they spiked very high when the silver squeeze attempt was occurring, but basically they've been trending down this year, as has open interest since the middle of the year. And there's plenty of silver around. We have record inventories in London, in New York, and in China. So there's plenty of silver around. There's no shortage of silver or in other markets. In terms of price outlook, as I said, we do expect record gold and silver prices 2024, 2025. But in the meantime, we've seen the prices come off since last August. We saw them come off in the beginning of this August very sharply, and they've been struggling to get over 1800, 1820 for silver. We do think that at some point we'll see spikes above that, and I wouldn't be surprised to see gold spike up to 1840 or 1850 in the last 2 months of this year, but I don't know that that's sustainable. And we do think that silver could strike over, if it breaks over 25, which it's tested twice since the beginning of September, it could spike up to 28, 28.50, but then we think it comes back down. We're looking for prices to be relatively modest over the next 5 quarters before they start rising as the economic and political heat. Talk just for a few minutes about platinum group metals, manganese, molybdenum, all those other metals that are really interesting are getting a lot of attention because of the growth of electric vehicles. But before I do that, let me put that into context and show you 2 slides from the International Energy Agency about where the world's energy is going to come from. This chart goes out to 2040. The 3 bars are 2018, 2030, and 2040. And you can see the world mostly uses oil, natural gas, and coal. And the IEA, which is not promoting, they're not lithium mining speculators, they're not oil industry people, they are a real research company chartered by their owners, the government. Be honest in their evaluation about global energy markets as they've been, as they are today, and where they're going in the future. And the IEA says over the period from now until 2040, the world's going to be using more petroleum, not less, more natural gas, not less, less coal, but still extremely high levels, and bio, nuclear, and other forms of energy. The next chart goes out to 2050. And you can see in 2050, the IEA thinks that natural gas and oil will still be the 2 major sources of energy for the world. Coal will have fallen all the way back to its level of 2008, which was significantly higher than it's ever been before. And it will be supplanted by all renewables after 2040, by 2050. So that's very important when you start talking about metals, because what it tells you is that in 2040, 2050, we're still going to be burning a lot of petroleum in vehicles, in power generating plants, and in other places. And if we're burning petrochemicals, petroleum, diesel, petrol, gasoline, jet fuel, we're going to be using platinum, palladium, and rhodium to clean up that exhaust. So there are people who have poo-pooed and their interest in platinum group metals because, hey, we're moving to electric vehicles and we won't need PGMs to petroleum burning engines. And they're wrong. And the PGM market in the mining industry because of that bad supposition. So these metals are very interesting to us from a long-term perspective. We think that the prices will stay high because of underinvestment in mining and because we're still going to be using them in autos. Our expectation is that by 2030, you might have about 16 to 20% of the auto market electric vehicles and hybrid vehicles. Hybrids still burn petroleum and still use PGMs. And by 2050, you might be up to about 56% electric vehicles. So you're still going to need PGMs for a long time. Manganese is interesting. We do a lot of work, and we have for more than a decade, on high purity manganese and high purity manganese sulfate, which is used in lithium ion batteries. And it's being used to supplant cobalt sulfate because there's not enough cobalt around and the price is going crazy. So we've seen cobalt prices come down as the battery manufacturers and auto companies say, we're going from using 30% cobalt to 20% to 10% to maybe nothing at all. And we're replacing that cobalt sulfate primarily with nickel sulfate and manganese sulfate. Manganese is used in steel manufacturing. Manganese probably won't rise as a metal price because of its increased use in lithium ion batteries, but high purity manganese sulfate will rise. And the companies that make high purity manganese sulfate will do very well. Molybdenum is a steel alloy. It's used in pipelines. It's used in drill pipe for oil, gas, and mining exploration. It's used in transmission pipes for oil and natural gas. Oil and natural gas transmission pipes are growing around the world, new pipes, and a lot of pipelines that were put in the 70s, 80s, and 90s are rusting out and need replacement. So there's a lot of demand on the horizon for molybdenum. Just last week announced that we are starting tantalum research program. We've picked up a couple of people who have researched tantalum for years at other places, and they're working with CPM Group now. Tantalum used in semiconductors, big growth industry. It's also used as a steel hardener in jet engines, which have been hammered by the pandemic and the lockdown and the collapse of international air traffic travel, but probably will rebound. Cobalt, lithium, and vanadium, as I said, we are producing so many lithium ion batteries, cars, and for energy storage systems, stationary energy storage systems, you will be recycling that lithium. So we're not big enthusiasts on investing in lithium mining. We are very interested in who's going to be refining and reusing that lithium. Cobalt, as I said, it's going away. Vanadium, you'll hear people talk about vanadium reflow batteries for energy storage systems. It's a technology that has just never quite been there yet. We've been following it for years. There are enthusiasts that always say it's about to become heavily commercialized, and we haven't seen it yet. That's my presentation. We can open it up for questions now. CPM Group, as I said, we're research-driven research and consulting. We try to get it right. We try not to be bullish or bearish. We try to get our analysis of supply, demand, and where the price is going correct. Thank you.
Thanks very much for that, Jeffrey. So for the Q&A, please do unmute your line, state your name and company, and fire away. Who has our first question following that excellent presentation from Jeffrey? I'm sure we'll have a few questions coming in, Jeff, in due course. But a quick one from me is, you know, obviously you've got some very bullish gold and silver views over the coming years. I mean, what's the pushback? Because, you know, equity markets have been flying, the economy's been doing quite well. Is that the sort of typical pushback you're getting?
Yeah, the pushback is that the financial crisis doesn't come. I mean, you know, if you, as I said, you know, if you look at gold and silver, the real drivers for prices are investment demand, and investment demand is driven by those 6 factors that I talked about. And we're looking at the world and we're saying things are not particularly bad now, but they're going to get worse. And the reality is that, you know, as I said, you know, earlier I showed you that chart on the gold price. We can't work with you, CPM Group, because you drive investment demand based on greed. You try to help people make money in gold and silver, and we sell our gold and silver products based on fear. We're not fear mongers. We don't think the world's going to collapse. We don't think the treasury is going to collapse. We don't think the dollar is going to collapse. We don't think inflation is hyperinflation is on the horizon. We're looking at an economy that is facing a lot of problems, growing deficits, growing private sector debt, corporate and personal. That has to be resolved. And it's probably not going to be resolved by fire, the way the Anabaptists say. It's probably going to be resolved by reduced consumption, reduced economic activity, reduced equity investments. And you're going to have economic and financial stringencies that are going to negatively affect other assets like stocks and bonds, which probably will cause investors to be thrown. Additionally, you look around the world and you look at the countries as well as among countries and governments, and that's problematic, and it's going to be negative for people. And it's also going to be, it already is negative for international trade, which is a very big propellant for real growth. So we're looking at an economic environment that it's okay for the next year or so, but at some point gets nasty. If we're wrong, it's that the world doesn't get nasty as soon or as bad as we think it is.
Good stuff. I think we may have a few questions coming in now from the audience. So Oscar's unmuted his line. Oscar, do you have a question? Well, we got one in the chat, Jeffrey, which is your outlook on oil.
Yeah. Evaluating our outlook on oil right now. I mean, obviously, because of OPEC plus and Russia being the plus. I think that we could back off of that, but it may not. So our view had been that we thought that the market clearing price for oil was somewhere between $50 and $65 a barrel for WTI, $8, $10 greater for Brent. And now our expectation is ratcheted upward. There were people that we respect who are talking about $150 or $200 oil at some point in the future. I think it's possible, but it would depend. For that to happen, you would have to see a much more hostile international political environment where OPEC and Russia actually seek to impose economic damage on groups. What OPEC has done over the last 20, 30 years, Sheikh Yamani in the 80s laid out a strategy and he was fired for it, but then they adopted it in the aughties and they said, what we did wrong in the 70s was we caused oil shortages and the price twice spiked fourfold. It went from 10 to 40, and then it came back down, and then it went from 10 to 40, and you had gas lines. And if you look at the period from 2001 to 2011, the oil price rose from $10 to $150. And it looked like that stock market chart that I showed, like a managed market. There was a volatility fell to historic lows because OPEC realized we can raise the oil definitely as long as we don't cause people distress. People will pay more. They're like heroin addicts. They will pay more for their oil as long as they can get the oil. It's only when you cause them to stand in line in the cold waiting for gasoline that they bought. So what you saw was this enormous increase in the oil price because OPEC said, let us manage supply to be slightly less than demand. And that's probably what they're going to be doing in the future too. So I don't think that they're going to use oil as a weapon, and I don't think the price is going to go as high as some people think, but I do think it's headed higher. And it's going to head higher because of a variety of political issues and economic issues. I mean, we have an enormous amount of capped oil reserves in the United States. And the government is in no position to tell those producers uncap that stuff. Actually are in some instances because a lot of the capped wells are on federal land. The government has chosen not to pursue that policy. So I think that oil prices will rise, probably not as drastically as some people think. I wouldn't be surprised to see $100 oil within 2 or 3 years. And that actually factors into our timing for our gold and silver oil price rises too.
Great stuff. What other questions have we got from the floor? Hi, David.
Yeah, I've got a question. Ed, it's just going back to the slide that was what matters to investment demand for gold, and the question of diversification. And I wondered if it's possible for you to say a little bit more about what kind of weighting in a multi-asset portfolio you would see for gold as we go into a period where you anticipate that the diversification demand is going to increase.
Yeah, let the record show that I did not ask David to ask me that question, but it's to our sweet spot. You know, the rubric has been 5 to 10% of your assets in gold, and that comes from research done in the early 1980s by Ibbotson and Associates. Ibbotson took data from 1968 when gold prices were freed to 1980. And they looked at an efficient horizon. They said, if I start with a portfolio that's 50% S&P and 50% T-bills or T-bonds, and I start adding gold in 5% increments, at what point does the risk fall more than the return rises or return falls? And what they found was that the optimal loading of your portfolio in that period, 68 to 1980, was 5 to 10%. You know, at 5 to 10% of your portfolio in gold, i.e. the volatility of your returns on a rolling average basis, but the returns had actually risen. After 10%, you start to see it go the other way, and risks started rising again, and they started rising faster than the returns. We read several times now. We redid it in 2017, and then we do it on. And looking at the data from 1968 to 2000, the optimal return risk-reward ratio was 25 to 30%. Now, when we did this the first time in 2017, and we showed these results to groups of economists and financial analysts and planners, everybody's jaws dropped. And quite frankly, our jaws dropped too, because it's very rare that we tell people that they should have 25 to 30% of their assets in gold. But that's what the numbers say historically was the optimal loading. So my view is that it's somewhere between 10% and 20%. Because you probably, you know, there are times, and 2008 to 2011 was one of those times when you could say, I should have 25 or 30% of my assets in gold. And there probably will be times again, maybe 2023 to 2025. But I think on an ongoing basis, a range of 10 to 20% probably is more prudent.
Thank you.
Jeff, we got another question in the chat. Well, we got one of the participants couldn't join at the beginning, so he just wanted a very quick roundup of your outlook for gold price, demand, and supply in the next 12 months. I know you covered that extensively over the first half an hour, but if you could just do that in a minute or two, that would be very useful. and
supply, demand, and price for the next 12 months or so.
Yeah.
Is that the question?
Yeah.
Okay. Our view is that for the next 12 months, the gold price pretty much moves sideways to slightly higher. Price range of, say, 1760 to 1860, 1880 may well hold for much of the next 3 or 4 quarters. By the end of 2022, we think that the price could start moving out of that range because the economic and political environment could be deteriorating. In terms of supply and demand, mine production is likely to rise slightly over the next year or so. Secondary recovery is probably going to be roughly flat. Jewelry demand and other industrial demand will rise very lightly. The big keys will be central banks. Central banks had pulled back when the price rose, but they started buying more last year. They bought about 8 million ounces last year. They're buying 8 to 10 million ounces, maybe a little bit more this year. And our expectation is going forward that they're probably going to be buying 10 to 12 million ounces next year. So you could see some upward pressure in prices from that. But the real key is investors. And our view is that as long as investors feel that they can get really good returns in stocks and bonds, they're probably going to be hanging back. We have seen, investors bought very little gold. If you look at this chart table here, investors bought very little gold in 2018, 2019, and again, 2015. There was a spike up here. It came back down, but last year they bought more than 40 million ounces of gold. There were a lot of reasons to be afraid and a lot of reasons stocks in your bond portfolios. So people bought a lot of gold. They're buying a lot of gold this year. Our expectation is that it may be less than 40 million ounces, but probably between 35 and 40 million ounces next year. So that we do think that the price, that will be supporting the price, but not necessarily driving it sharply higher.
And is gold manipulated down by monetary authorities?
No, it's not. In fact, since they own more gold, they own more than 1 billion ounces of gold, they have every reason not to do that. But beyond that, there's just no incentive there. And there's no evidence that it's happened. You have people who, there used to be people who talked about the grand conspiracy, including the Fed and other central banks and major banks trying to do it. And then it was a smaller conspiracy, and maybe it was a few banks in London doing it. Then it was, oh, well, it's a manipulation. And now it's spoofing. And you found a few people at Barclays and JP Morgan and other companies that have been accused of spoofing. And you found JP Morgan of being accused by regulators of creating an environment that encouraged spoofing, not only in gold and silver, but in currency markets and stocks and bond markets. So you've got spoofing that goes on, and it is a problem. But there's no grand conspiracy, and there's no evidence of a grand conspiracy.
Great stuff. So have the cost of mining gold per ounce gone up in the last 10 years? And what is the expectations going forward?
I don't have the numbers right in front of me. If you go back 10 years ago, the cost of production is actually going down. And that's because one of the things that happens is that the gold mining companies don't necessarily, they chase the price higher. So when the price of gold rises, their costs were also rising. Oil and reagents and other factors were all rising at the same time. But they also gave away some of the costs are much stickier than the price of gold. So we saw the gold prices, cost of production rising sharply during the bull market into 2011, 2012. And then after that, you started seeing them cut back. Now, unfortunately, what they do is exploration and development, and to some extent, their home offices. So you saw fixed costs or non-cash costs fall greater than the cash costs. The cash costs are stickier, but they also have declined. we saw a plateau, and now they're starting to rise. They're not back to where they were in that period, 2019 and 11, I don't think, off the top of my head, but there are upward pressures on gold production costs again. That said, the costs are significantly lower than the price of gold, so that gold mining on a cash operating basis is extremely profitable right now. And some of the problems that you have are in the non-cash operating costs, the ongoing sustaining costs.
Great stuff. You got another question here from Theron. You mentioned you look at technicals, fundamentals, history, etc. What specific factors underpin your $2,500 gold price view?
Yeah, it's primarily investment demand, and our expectation that investment demand will be in not only this 40 million ounce range, but possibly go over 50 million ounces in the next financial crisis. If I look at the weightings in our econometric modeling, you're really talking about investment demand and the economic variables that drive it, representing more than 40% of the weighting on driving gold prices. We do look at mine production relative to total supply, and we do look at fabrication demand, but those factors, the price tends to affect mine production, secondary recovery, and fabrication demand more than mine production, fabrication demand, and recycling affect the gold price. So it really comes down to that third category, which is stock demand, which is a combination of investment, private sector investment demand, which is highly price inelastic. They tend to chase the price higher. And central bank buying, which is more price elastic in that central banks like to buy low. But as I said earlier, one of the factors that we're seeing, if you go back, in 2000, 2013, most central banks said, I will buy gold below $1,000. By 2013, they said, okay, it's not going to get back to $1,000. So I will buy gold below $1,300. And when the gold price came down to $1,180, $1,200, $1,250, they were buying more gold. Then when the price rose, they pulled back. And then this year, what we saw, which was very telling, was central banks stepping up their gold purchases at that 1780 to 1840 range, which tells you that the central banks, they're still trying to buy low, but their definition or their quantification of what a low price is has shifted sharply upward. So we think that central banks will continue to be larger buyers on a historic basis over the next several years. But then the real kicker is this investment demand. And that investment demand is driven not by the fundamentals of supply and fabrication demand, it's driven by the economic and political environment.
Great stuff. I was going to ask this one as well. Can Bitcoin replace the role of a safe haven asset, in your opinion, of gold?
Gold is a tangible asset that's no one else's liability, and you own it, and it's there. Bitcoins are, and it has geologically limited supplies, although they are enormous. Currencies actually have unlimited supply. There is a guy who you don't know who says no, but his word is probably trustworthy than a central bank that says, no, we'll limit the supply of our currencies. They are, in fact, the antithesis of gold. There's nothing tangible. You don't know it. So when you have a Bitcoin, Bitcoin, there were people who lost like $120 million several years ago in Japan over a Bitcoin scandal. And they stood around on the Ginza saying, who do we complain? If Japanese yen, we could go to the Ministry of Finance or the Bank of Japan and complain. But we don't even know who runs this thing. So Bitcoins are the ultimate ethereal non-asset that could disappear. And my own view is that while cryptocurrencies will continue, they will be national currencies in the future that will be electronic currencies, and that private sector cryptocurrencies will probably disappear and possibly cause more than $1 trillion of investor losses when they disappear, which is probably going to be very positive for gold and silver as those investors lick their wounds and turn to something that's really tangible.
Very interesting. Moving on to a different commodity. Can you envision industrial demand for platinum relating to hydrogen fuel cells being a potential catalyst to reduce the substantial price discount of platinum relative to gold?
I have a problem with fuel cells. I've been studying them and watching the market since the 1970s. And since the 1970s, the platinum industry in South Africa keeps saying, oh, fuel cells will be using 3, 4, 5, 600,000 ounces a year within 10 years. And it just hasn't happened. And if you look at fuel cells, they make sense for stationary power generation, especially where you need dependable backup and where you have remote needs for power. And they make sense for fleets, intra-city buses, airport fleets of all those little vehicles running around the tarmac, warehouse forklifts, places where you have a fleet manager who can heat hydrogen into the fuel cell vehicle. It don't make sense for on-the-road vehicles. They probably don't make sense for heavy-duty vehicles either, although that's where the industry is looking right now. So I don't see fuel cells particularly being a very big source of power. They have technical issues and they have cost issues. So I don't see fuel cells doing that. In addition to that, the fuel cell manufacturers have already reduced their platinum requirements more than 40 years while I've been watching. And in many cases, they can get rid of the platinum entirely and use other metals instead. So I don't see fuel cell vehicles being a major source of demand for platinum.
Have we got any final questions? David, it looks like you're back to...
Yes, I just wanted to go back to the comments that were made about the possibility of a global recession, particularly in 2024, 25. And one of the things that was mentioned was that Brexit could be contagious and that there could be a weak euro in 2024, 25. What I was wondering was if it turns out that the European Union proves to be more cohesive and the euro is not a weak currency during that period, how much does that change your global recession scenario and how much would that change your gold price scenario?
Probably it changes our probability less than 2% and our gold price less than 1%. So it's not a major factor there. I hark back to the US Declaration of Independence, which has a line about how history has shown that people will suffer intolerant governments far longer than they ought to. And I do think that the euro and the euro system has a lot of advantages for a lot of people throughout Europe. And even while they gripe about it, they probably fully understand that they're much better off in a eurozone than they are without it. But you do have, since the mid-1980s, an overarching political or decentralization of political power, at least on the part of people. Governments are still centralizing as they were from the Great Depression and World War II into the 1980s, but people have changed their attitudes. And you see this in Northern Europe, you see it in Italy, you see it in Spain, you see it in China, although they won't admit it. You see it in Russia, you see it in Eastern Europe, you see it in the United States. And so there is this political pull away from centralization toward more localized control of government. And I think that that's one of the factors that's going to be an underlying theme in terms of domestic politics. And while I don't necessarily see or support the idea of the Eurozone US Constitution is 5,000 words. The EU Constitution is 5,000 pages. What are we doing wrong? The government said, up yours, right? I mean, Cameron really to do something here, or my people just want to leave. And the EU government said, no, we actually don't have to do anything. So they left. And I think that when the EU doesn't roll over and starve to death, which it won't, other people on the continent are going to be looking at that and saying, wow, devolution isn't necessarily a bad thing. Doesn't mean that the Eurozone and the EU have the same problem in the United States. You can have the majority of the people saying, we really need to redefine tax with people. But if the government leaders turn a deaf ear to that, you've got problems.
Thank you.
Great stuff. We've probably got time for one final question if there is one. Okay, I think we'll call it a wrap. Jeffrey, on behalf of everyone on the call, many thanks for a very fine introduction to CPM and your excellent insights. You covered a hell of a lot of ground. I'll follow up with all the participants in the hope that they'll be interested in using CPM as part of their investment process going forward. We'll have the slides, audio and transcript from this call on our website shortly, which will give you access to if you don't already have a login. Many thanks again, Jeffrey, and for all participants, do look out for future calls we're hosting.
Thank you.
Thanks so much, Jeffrey. Take care.